fractional reserve banking, if you put $1,000 in the bank, they only have to keep $100. They only need to keep 10% of the reserves. Put $1,000 in the bank, they keep $100 in case you come back, but they're going to lend $900 out. So if you come back the next day and you want your $900, they've already lent it out. They don't essentially have it. So what they're banking on is that there's a whole bunch of depositors putting more money in so that when you come in, they have the money for you. But what happens is if y'all come in at the same time, they don't have the money. So what happened with Silicon Valley Bank is a whole bunch of people went in and asked for all of their money, which is called a run on the bank. Silicon Valley Bank didn't have all of their money. They may have had 10% in reserves, but people wanted more than 10%. So they had to sell liquid capital in order to get that money. What is their liquid capital? Their bonds. Where were their bonds priced? At 2%. With interest rates as high as they are today, their bond value went down. So ideally, what they would have liked is for a lot more time for depositors to be depositing money so they could go buy bonds at a higher rate. And then if there was a run on the bank, they would have enough money in liquid assets that they could sell off and they could pay all their depositors. That was not the case. The rates went up and not enough money is coming in. They can't replenish their bond value as quickly as people are wanting money. So they had to sell their bonds off. The Fed stepped in. The FDIC stepped in and said, you know what? We're going to take over. This bank failure is just the beginning of what happens with low interest rates when we are buying assets at such a low rate. And now that is a devalued asset because everything that we can buy today is higher. That is not how banks want to operate. The fact that they don't need to keep money in reserves is what got them in this problem to begin with. If the bank had to keep 100% of your reserves and make better financial decisions, there wouldn't be runs on the bank. They would have all the money people deposited. Fractional reserve banking is the problem. Don't do business with the banks. Life insurance companies can't do that. They can't inflate our dollar. There can't be a run on the life insurance company because they have the money there. So let's go back to infinite banking. What did Nelson say? Don't do business with banks. Because if we allow them to do fractional reserve banking, they can lend out 9 times what they got in. And they just keep on lending and they dig themselves this huge hole. What happens when we do IBC is we are not allowed to do that because the life insurance company does not get to keep 10%. They have to keep 100% of what we put in liquid and accessible to us. They don't have this immediate deficit that they have to go scramble to be selling off liquid assets that are worth basically nothing. As people are asking me about what's going to happen and how does this relate to infinite banking, it is why we do infinite banking. It is not for rates of return. It is not for arbitrage. It is for us to have control of that money.